This content is for educational purposes only and does not constitute financial advice. Trading involves significant risk. Always do your own research and consult a qualified financial advisor before making any investment decisions. There is one volume event that appears right before the biggest reversals on the chart, and most traders read it completely backwards. They see a massive volume spike on a huge green candle, and they think, this is the strongest move yet. I need to get in now. So they buy at the peak, and within days they are underwater. Or they see a stock crashing with enormous red candles and record volume, and they panic sell at the very bottom, right before the biggest bounce of the year. This is what Climax volume looks like, and if you do not understand it, you will keep getting caught on the wrong side of the biggest turns. Here is the counterintuitive truth that separates professionals from amateurs. When volume is the loudest, when it is screaming, when every bar on the chart looks absolutely certain about the direction, that is often the exact moment the move is about to end. The crowd is the most confident right at the top, the crowd is the most terrified right at the bottom, and the volume proves it. In this lesson, you are going to learn how to read Climax volume so you can stop buying tops and selling bottoms. You will learn the blow-off top, the selling climax, and the exact sequence of signals that tells you a major reversal is about to happen. Think of it as the volume fire alarm. When it goes off, something big is about to change. Let us break it down. So what exactly is Climax volume? Climax volume is an extreme volume spike that occurs at the end of a sustained move, not at the beginning. And that distinction, the location of the spike, is everything. Remember last lesson, we said a volume spike at the start of a breakout is bullish. It confirms the move. But a volume spike after a stock has already run for days or weeks, after it has already made a huge move in one direction? That is exhaustion. That is the last wave of participants piling in, the latecomers, the FOMO crowd, the people who could not take it anymore and finally gave in. This is especially important right now in the AI and semiconductor space. These stocks move fast. When Nvidia runs 20% in a week, or AMD gaps up on an earnings beat, there is always a final day where the volume goes absolutely nuclear, and everyone on social media is screaming about how this stock is going to the moon. That final day, where the volume dwarfs everything before it, is often the climax, not the beginning of more upside, the end of the current run. In a rally, the buying climax is the moment when the last buyer buys. Think about that. If everyone who wants to buy has already bought, who is left to push the price higher? Nobody. The fuel is spent, the car is running on fumes, and the only direction left is down. In a sell-off, the selling climax is the mirror image. It is the moment of maximum panic when the last terrified holder finally capitulates and dumps at any price. Once they are out, there are no sellers left. The selling pressure evaporates, and price bounces. Here is an analogy I want you to remember. Think of a climax like a sprint finish in a race. The runner gives absolutely everything in the final stretch, crosses the line, and then collapses. That collapse is what happens to price after a climax bar. The energy is completely spent. There is nothing left to give. This is why the biggest volume bars often appear right at the top or right at the bottom. They are not signals of continuation. They are signals that one side is completely exhausted. Let us walk through the buying climax pattern step by step, because this is the one that traps the most people. It starts with an uptrend. The stock has been climbing for a while, maybe weeks, maybe months. Each push higher is a little steeper, a little faster. The candles are getting longer. The gains are accelerating. This acceleration is the first warning sign. Healthy trends move at a steady pace. When the pace starts to go parabolic, when the chart starts to look like the left side of a mountain, that is the market telling you the crowd is getting greedy. Then comes the climax candle, one enormous green bar, maybe 10% in a single day. The volume on that bar is massive. 3 times, 5 times, sometimes 10 times the recent average. Social media explodes. Everyone is talking about it. It feels like the most obvious buy in the world, and that is exactly when you should be looking for the exit, not the entry. Because what follows the climax candle? Almost always a reversal candle, a shooting star, a bearish engulfing, a doji, something that says, the buyers gave everything they had, and they could not hold the high. This 2-bar sequence, the climax bar plus the reversal bar, is one of the most reliable topping signals in technical analysis. If you see a parabolic rally followed by a massive volume spike followed by a reversal candle, that is 3 alarm bells going off at once. The top is very likely in. Now let us look at the mirror image, the selling climax, also known as capitulation. This is what it looks like when fear wins. The stock has been falling for a while. Every bounce fails. Every attempt at a recovery gets sold into. The trend is clearly down and the losses are accelerating. Candles are getting longer. The drops are getting steeper. The financial media is running worst-case scenario headlines. And then comes the capitulation bar. One massive red candle. Maybe a 15 or 20% drop in a single day. The volume bar is the tallest on the entire chart. It looks terrifying. It feels like the stock is going to zero. And that is exactly when the selling is about to stop. Because here is the mechanical reality. Who sold on that bar? Everyone who was afraid. Everyone who could not take it anymore. Everyone who had been holding through the decline and finally broke. Once they are out, they are out. The selling pressure disappears. And what comes next? Often a hammer candle, with a long lower wick showing that buyers stepped in hard at the lows. Or a bullish engulfing bar swallowing the entire capitulation candle. That hammer or engulfing on the candle after the climax volume spike is your signal that the bottom may be in. Think about the major corrections in recent years. The COVID crash in March 2020, the October 2022 bear market bottom, the August 2024 sell-off. All of them had a selling climax with massive volume followed by a reversal candle. If you know how to read this pattern, you can spot potential bottoms before the crowd even realizes the selling is over. Now here is where it gets tricky and where most people mess up. How do you tell the difference between a normal volume spike and a climax spike? Because on the surface, they look the same, a big volume bar. The answer is location. Where in the move does the spike occur? A volume spike at the start of a move, right as price breaks through a level, is confirmation. That is the breakout volume we talked about in Lesson 11. You trade with that spike. But a volume spike at the end of a move, after price has already traveled a significant distance, after the candles are accelerating, after the crowd has fully committed, that is climax volume. You trade against that spike, or at the very least, you do not add to your position. The same looking volume bar means the exact opposite thing depending on where it appears. This is why I keep hammering the point. Context matters more than the signal itself. A hammer candle at support is bullish. The same hammer in the middle of nowhere is meaningless. And a volume spike at a breakout is fuel. The same volume spike at the end of a parabolic run is a warning siren. Train your eyes to ask, is this the start or the end? Quick pause. If you are enjoying Phase 2 so far and building real skill, do me a favor and hit that like button. Subscribe if you have not already. Tap the bell. It takes 2 seconds and it makes a real difference for the channel. And if you are leveling up your career alongside your trading, check out Resume Zenith. Clean, professional resumes, built fast. Link in the description. Alright, let us get into the practical framework. Alright, so you see a potential climax. How do you actually trade it? Let me give you the step-by-step framework. Step 1. Identify the extended move. The stock must have already made a significant run in one direction. A climax cannot happen on day 1 of a move. It happens after weeks or months of trending. Step 2. Spot the acceleration. The candles are getting longer. The gains or losses per day are increasing. The chart is going parabolic. Step 3. The climax bar. A massive candle with volume that dwarfs everything around it. 3 to 5 times average is notable. 5 to 10 times average is screaming. Step 4, and this is the most important, wait for the next candle. Do not act on the climax bar itself. You never try to pick the exact top or bottom. You wait for the confirmation candle, the reversal signal. A shooting star after a buying climax. A hammer or bullish engulfing after a selling climax. Only when you see that reversal candle do you have a tradable signal. And step 5, manage the trade with tight risk. Even the best climax reversals can take time to play out. The stock might bounce, retest the extreme, then reverse. Your stop goes just beyond the climax candle's extreme, the high of the buying climax, or the low of the selling climax. Let me connect this directly to what is happening in the market right now. The AI and semiconductor stocks have given us textbook climax volume examples over the past couple of years. Think about the run-ups in stocks like Nvidia. There were stretches where the stock went parabolic, gains accelerating day after day, the volume building and building, social media going absolutely wild. And then, at the peak of the frenzy, a massive volume spike with a reversal candle the next day. That was the buying climax. The stock pulled back significantly. Did it mean Nvidia was done forever? No. Long-term trends can survive climax events. But it meant the short-term move was exhausted, and anyone who bought on that climax day was underwater for weeks. The same pattern plays out in the semiconductor ETF SMH. When the entire sector gets hot, when every fund manager is piling into chip stocks, you see the volume on SMH steadily climbing until it hits that one enormous spike bar. If you know what to look for, you can see the top forming in real time. On the flip side, during the sharp sell-offs in semiconductor stocks, there were days of absolute panic selling. The volume bars were towering, the candles were massive and red, and it felt like the entire AI trade was over. But then a hammer candle printed right at the bottom, on the highest volume of the entire move. That was the selling climax. Buyers stepped in hard, and the bounce that followed was sharp and fast. Here is a practical tip. When you are watching any AI stock and the volume today is 5 times or more than the 20-day average, and the stock has already been running for 2 or 3 weeks, start paying very close attention. That is the zone where climaxes happen. You do not need to predict it in advance. Just watch for that extreme volume bar after an extended move, and then watch the next candle like a hawk. These patterns repeat again and again and again. The specific stocks change, but the volume signature is the same. Learn to recognize it, and you will see the turns forming before the crowd even knows what happened. Let me warn you about the 3 biggest mistakes traders make with climax volume. Because knowing the concept is one thing, but not falling into these traps is what actually saves you money. Mistake number 1, confusing the climax bar with a breakout bar. Remember, a breakout bar is at the start of a move. A climax bar is at the end. If you see a massive volume bar and immediately think buy because big volume equals good, you will get destroyed at tops. Always ask, how far has the stock already moved? If it is already up 50% in 3 weeks and the volume just went nuclear, that is probably a climax, not a breakout. Mistake number 2, acting on the climax bar itself. The climax bar is the warning. It is not the entry. You must wait for the confirmation candle, the reversal signal on the next bar. Buying or selling directly into the climax is picking tops and bottoms, and even professionals do not do that consistently. Wait one more candle. Mistake number 3. Thinking a climax means a permanent reversal. A buying climax at the top of a strong uptrend often leads to a pullback, not a bear market. The stock might pull back 20% and then continue its long-term trend. The climax tells you the short-term move is exhausted. It does not tell you the whole trend is over. Trade the pullback, not the apocalypse. All right, homework time. I want you to build your climax spotting skill with real charts. Here is a structured exercise that will lock this into your brain. First, pull up the chart of any AI or semiconductor stock on TradingView. NVIDIA, AMD, the SMH ETF, Broadcom, whatever interests you. Second, zoom out to the daily chart and find the biggest volume bars over the past year. They will jump off the screen, the tallest bars on the volume panel. Third, for each one, ask yourself, was this at the start of a move, which would make it a breakout confirmation, or at the end of a move, which would make it a climax? Fourth, look at the candle after each big volume bar. Was there a reversal candle? Did price actually turn? Write down what you find in a simple table. Date, ticker, volume spike type. What happened next? I guarantee you will start to see the pattern. Climax bars at the end of extended moves followed by reversal candles. It is one of the most reliable patterns in all of trading, and now you know how to read it. For extra credit, do the same exercise on a stock. Outside the tech sector, try an energy stock or a biotech stock. You will see that climax volume works the same way across every sector. The crowd is the crowd, and exhaustion is exhaustion, regardless of what the stock does. And the full climax volume checklist is in your free cheat sheet at candlelogictrading.com. And now you understand one of the most powerful and misunderstood signals in all of technical analysis. Climax volume is the market screaming at maximum volume, and the message it is sending is the opposite of what most people think. The buying climax is the top. The selling climax is the bottom. Learn to read these events, and you will stop buying the peak and selling the panic. In the next lesson, we tackle something equally important: volume and trend health. How do you know if a trend is real and likely to continue, or if it is quietly dying and about to reverse? Volume gives you that answer too, and we will show you exactly how to read it, bar by bar. So subscribe, hit the bell, and I will see you in Lesson 13. New lessons every Sunday, Tuesday, and Thursday. If this helped you, smash that like button and share it with a friend who keeps buying tops. Go practice, protect your capital, and I will see you in the next one. This content is for educational purposes only and does not constitute financial advice. Trading involves significant risk. Always do your own research and consult a qualified financial advisor before making any investment decisions.